Hey, so what are REITs? Why should you invest in REITs? Do you know what REITs are? Real estate investment trusts. If you want to own real estate but you don't want to be dealing with the tenants, you don't want to be dealing with, I don't know who owns what, you don't want to be dealing with people who are in your property, you don't want to be going anywhere physically, you don't want all that hassle with regards to owning a physical property, the best place for you to invest in property or in the real estate market is through what we call the REITs. So REITs are basically like a mutual fund, like an ETF, whereby investors come together, they invest in a particular trust, and that trust invests in those real estates. So they're like more like third parties, and then they share the profits with the shareholders. So these trusts basically source certain funds, or they source money, and then they build or they buy certain properties, and then of course when they have the profit, they share that profit with you as the shareholder. So you do not have to do anything, you just have to sit down and buy your shares. It's a very simple process of investing in the real estate, and right now they are REITs in Kenya. So that's why I'm doing this video. Hey guys, welcome to Case Money Matters, and once again here at Case Money Matters we talk about the money mindset, how to make that money, how to manage that money, how to enjoy that money, how to invest that money, and how to assure yourself of a lifetime of income. So right now we're going to talk about real estate. I know Kenyans love real estate. It's like when we were growing up, the only investment we ever thought about was real estate, and now there are ways in which you can invest in the real estate by just owning shares in a REIT, which is the real estate investment trusts. So now you don't have to go and own that land, you don't have to go and buy that house, you don't have to go and buy that hotel, you don't have to go and buy that showroom, you don't have to go and buy that mall. You can as well own a share of that mall from where you are sitting. It has become very difficult for most people to invest in real estate, and therefore the government saw it fit to encourage most people to invest through shares of REITs. So basically you are investing in the real estate like you're investing in stocks, and this has become a very lucrative way of investing in the real estate market. So there are different actors in the REIT sector in Kenya. Like I think there's Stanlib, there's UAP Investment, there's Fahari, there's Nabo Capital, and I think there's CIC. So there are different actors in the sector of the REIT in Kenya. So basically, we as the shareholders have bought the shares. They use that to invest in the real estate market, those particular trusts, and then when there are profits, they share those profits with us. REITs are very good investment instruments for those who want to invest in the real estate, but they don't want to own any real estate in real sense. So there are different types of REITs. We have what we call the income REITs. This whereby you come together, pull those resources together, and they use the investors' money to acquire those properties, and then they can now have income from those properties. So they can acquire either residential properties or commercial properties, it doesn't matter. And then when they get income from those properties, they distribute those income to their investors or their shareholders. So it's basically meant for income. Income REITs are meant to distribute their profits or their income with their investors. And then number two, we have the development REITs. Here again, the investors come together, they pull their resources together. Let's say they want to develop like a mall. They decide, okay, let's pull these resources together from the investors, let's build a mall here. And then when they are done with the building or developing that particular mall, whether it's a mall or a residential area, they then make a decision on whether they want to sell it, whether they want to retain it, or whether they want to turn it into an income REIT, such that the income from that particular development is distributed to the shareholders. So it depends, but development basically is like a development of properties, like property developer. So they take a particular contract, develop it, complete it, is their own, and then they bring that income to its people or whatever it is. If they lease it, if they sell it, if they turn it into an income REIT, that depends of course on the board and the managers and what is agreed upon. So development REIT is the second one. And then finally is the Islamic Rates, the Islamic Real Estate Investment Trust. These are basically meant to comply with the Sharia law. So there are certain things that must be done to ensure that they do comply by those laws and the laws of the Islamic religion. So this is basically for those who who follow this particular religion. Those are the three types of REITs that you need to think about. So you want an income REIT, a development REIT, and of course if you're a Muslim, you may want an Islamic REIT. So what are some of the advantages of investing in a REIT? Number one, they are exempted from double taxation. They are exempted from the corporation tax, and they're exempted from income tax. So this is a very good feature of the REITs. So I know if you own a house physically, I'm sure you're paying a lot of tax already. And of course, there are some exemptions, I know. But with REITs, because the government is trying to encourage them, so they are exempt from double taxation. They're exempted from the corporation tax and from the income tax. So that's a very, very important point. You want to invest in a tax efficient manner. So REIT is a very good area you could invest in if you are in Kenya. The second advantage is capital access and access to investments. So most of the time it's very difficult for you to start investing in the real estate sector on your own because of the amount of money required. But through REITs, it means you bring up a pool of investors, and therefore it makes it much easier to invest in these huge malls, these huge shopping centers, these huge residential areas without the requirement of that huge capital for someone to do it on their own. So it gives people who are in the middle class or even lower class or even, you know, higher middle class access to certain things that in real sense they wouldn't have had access to. So with the REITs, you gain access to the market, you gain access to this kind of investments, and therefore it reduces the capital intensiveness of the real estate sector. So the return on investment of the yield of the REITs has been so good in Kenya so far. They give you almost 10, 8% depending, of course. Like if you look at the statistics lately, they have given up to sometimes like 12% based on the kind of investment that the REIT has. It could be the commercial would give higher or the retail would give higher. So it depends on what rate it is and where they invest their money. But looking at the returns consistently over the years, REITs have given very consistent, very good returns. So if you want to invest and you want good yield out of your money, REITs is a good way to go. And this is very consistent because they have looked at the statistics on a longer period of time. So that means, again, the growth is consistent with REITs. So if you invest for a long period, you are sure to get good money. And then of course we talk about liquidity. You know, if you invest in a house or a land somewhere, there's no liquidity to it. You have to basically sell it, you have to convert it to cash money. But with REITs, it means the money, you're only owning the shares, and that means you can easily convert your money to liquid if need be. So that liquidity again makes it very attractive to most investors. It means even if you invest millions and millions in there, you can access those millions when you require them. So that's a very, very attractive feature, because sometimes when you own physical houses, physical malls, for you to actually sell a mall, it takes a lot of time and a lot of resources and a lot of energy. So instead of that, if you're owning REITs and you're not owning any physical property, if you want to sell your shares, it becomes much easier to liquidate them. There's the issue of diversification. REITs can help you diversify your portfolio. Number one, you diversify your portfolio in two ways. If you are owning stocks and other commodities and you're owning bonds, it would be good to have REITs because REITs are not affected as much by other factors that affect stocks. So they're not very correlated with regards to what affects them. So it will give you a very good diversification. If you have stocks, it's good to have some REITs too in your portfolio. That's number one advantage why you should have it. Number two, it also leads to diversification in that you don't just buy residentials. If you are investing on your own, most probably you only have your houses or you only have your land. But when you invest in REITs, most likely they have very diversified portfolio in that they have developments in the residential areas, some property in the commercial areas, they have some properties in industrial buildings. So that gives it a very diverse portfolio, and that means your money would likely be safer when you invest it with the REITs. So REITs is a very good avenue for investing in the real estate market. And then of course there's the professional management. So most of the time it's very difficult to manage this thing. So someone who just comes from school, comes from the university, wants to start investing, you don't know anything about the property market, there's so much to learn, there's so much to understand. But with REITs, you have access to professional managers. People will help you manage everything that you want. People will help you manage your money. So your part is basically to invest your money. And then there are professional managers there who are deciding on what to do, where to invest the money, how to get the returns. It's not your duty, it's not your work. If you were to go to these managers or talk to these investors or talk to someone like me who is an investment advisor, I would charge you so much to speak to me for just maybe an hour. But through REITs, you have access to that professional management and you don't pay for it directly. It could be, yes, they charge a fee, but the fee compared to how much you pay an individual, for example, would be much higher. But now you have access to these professional managers at a very low fee, and they're managing everything for you. There's no day you worry about, oh, what's happening in the house. You understand? So it's very easy, very good process of investing in real estate. And then the issue of transparency. Because they are publicly traded, these are shares that are in the public, so it makes it very transparent. So they are always required by law to disclose their financial information to disclose everything that the investors need to know. So that transparency again gives trust and gives a bit of confidence to the part of the investor that whatever it is they're investing in, they know it quite well. Because I always say before you invest in anything, you must understand it. So the way you want to understand the rates is that you make sure that you know what you're investing in, that you can see their financials, you can see everything they've done, you can see their performance over time. So this makes rates very, very attractive and very good investment vehicles. Finally, there's a very simple tax treatment with regards to rates. So you can easily deal with the tax issues. Most of the taxes are exempt. You only pay the tax at the individual level. So the tax that is supposed to be paid at the corporate level is not there. It's exempt, and it's also exempt from the stamp duty, from VAT. So that makes it very easy to deal with the tax issues in rates, which is more complicated if you're dealing with your own investment or your own house or your own building, whatever it is. It makes it much more complicated. So yes, that simplicity with dealing with tax issues, again, is an investment that most people who don't want to deal with taxes would want to go into. So yeah, I've talked about everything about rates, the advantages, why you should start investing in the real estate investment trust right now. But what are some of the disadvantages? Anything that has advantages has disadvantages. And in investment, you should always make sure you know the disadvantages of something. Let nobody sell you something and not tell you what are some of the shortcomings. Number one, of course, these tax exemptions are things that may change with time. So when they change, of course, that will be affecting the returns that the investors get. But that's something that's not happening yet, so I actually do not even call it a disadvantage as such. But yes, that's number one disadvantage that someone could actually quote. Number two is, of course, the fact that sometimes you have no lease, or there's change of lease, or if it's a mall, for example, people are not going to the mall, like the COVID times, you could find the mall is empty. So of course, those kind of things affect the returns that the investors get, just like it affects anyone else who is owning that particular mall. So that's another disadvantage someone would actually quote, but that's a risk that you're taking on when you're investing in the real estate market. Another disadvantage could be the political time. So if there is political turmoil, political issues, political instability in a country, it definitely affects the quality or the amount of money you're getting from such investments. Political instability will always affect investments. That's something that's for sure, and that's anywhere else. So if you're an investor, you know that's like obvious, that will always happen. This is one of the disadvantages that someone would say, oh, during political instabilities, this could actually be a bad investment, because at some point these real estates are owned physically by the trust. So yes, they are affected. There is competition from other asset classes. There are treasury bonds, there are treasury bills, and there are of course stocks that could compete with rates in terms of returns. If you're getting, let's say, 10% a year, if you can get 13-14% in the bonds, which are much safer, then someone would say, why should I not invest in the bonds? And I don't know if that's a disadvantage, but it depends on your preferences, your portfolio, your investment objectives, and many other things. And then of course, because of the requirement, the high capital intensity, it requires many investors, which sometimes they don't get. So there's a limited pool of investors who invest in rates, and that affects that sector because it means they don't get the amount of money they need for them to start investing. Like for example, the pension schemes can only invest up to 30% of their funds into rates, for example. So that means that they are limited on the number of people who can actually invest in them. And finally, people are still not so sure about them. People are still not confident. People are still avoiding them because of lack of information or because of just lack of proper education. But these are some of the best investments that someone could actually take. So if you want to invest in the real estate and don't want to own any property, this is the direction you should be taking. Right now, not so many are listed. I think as I do this video, only one rate is listed in the NSE. I'll do that check again for you and let you know in the next video. But if you want to start investing in rates, please do as soon as possible. And this is a way of investing in the real estate market without actually owning any property. And the investment returns will get better and better with time because most people are getting into this and the government really encourages it. So guys, thank you so much for listening to me. And if you're still here, I say thank you, subscribe, like, share, and remember to start investing today.